All right, everybody. Julian Brigden here, MI2. And, the fireside chat thing, overrated. How about a mountainside chat?
A mountainside chat, yes. With these 1975 circa microphones.
That's right, Dick Clark Live.
Yes, exactly. How are you, mate?
I'm good. How are you?
Good.
I love when
busy,
you do this.
Busy.
Well, I mean, I maybe caught you on the wrong day. We are looking at about a 2.5% down day this Wednesday this week on the NASDAQ. The last I checked, the S&P was down 1%. However, the Dow was up, and it was up also meaningfully yesterday.
Yeah.
So let's start there. I mean, the writing on the wall. Rotation? Is it a rotation?
It's obviously physical rotation, but you're asking a bigger question. So last week we sent clients a chart where we showed a chart of the S&P versus the equally weighted S&P, the SPW. And we'd hit levels, Trevor, which we've only hit 3 times in, let's call it, this century. This century, that's a good one, this century. March of 2000, high of the dot-com bubble, okay? March of 2009, the low of the post-GFC sell-off. And I think it's October or September 2020, the low of the COVID sell-off. Now, what we wrote to our clients was, you're supposed to sell the S&P, which is tech-heavy. You're supposed to buy the equally weighted, broader index, okay? Since then, we've obviously seen some big moves, so far so good. And this is giving wings to this sort of view that the market has, that we're in this positive rotation, that finally, I can't do inverted commas because of the microphone, that finally the rally is broadening out. Okay? But here's the thing, there are 2 ways that ratio can correct off that trend line. Now, the nice correction, March of 2000, March of 2009, off the GFC lows, COVID lows, right? And that is what I would call a nice rotation. And that is a reflationary rotation. So in other words, the Fed is cutting, the dollar's going to weaken, we're going to go into this period of extended growth, the economy's going to reaccelerate, you're supposed to come out of your defensive tech and you go into your broader stocks. I think that's bollocks. To put a blunt stop on it, I think that's absolutely rubbish. I think the concept, when you look at the price of assets, we've seen none of the corrections that we saw post the GFC, not even, we're sitting on the highs, not on, 40-50% declines, and the same after those COVID. So I don't think from a price action, those metrics support that. And the second thing, I don't think the macro supports that, because to have a reacceleration of growth at this point would mean that you would boost employment. You would, and I don't see how we do that from 4%. In both of those other instances, we were talking double-digit levels of unemployment.
Right. We're at 10% at one point during COVID.
Yeah, and then we were during the GFC, right? Yeah. So the other words is, as the economy reflated and expanded, we had the capacity to kind of grow into. I think this actually looks much more like the dot-com highs. So March of 2000. I look at a market which is fully invested in US stocks, US tech, to fund a massive current account deficit. And I've been working on the numbers. The US is sucking in from foreigners just on the current account deficit, let alone the budget deficit, just on the current account deficit. It requires $1 trillion of foreign funding at the current run rate every single year, like an additional. Right? If the current account stays at this level, the flow level, not the stock, not the how much we've borrowed thus far, but on a flow basis, we require $1 trillion of inflows. Right? Now, where do those inflows go? US banks can borrow them, and they've borrowed a little bit more, but not much. Right? They're borrowing about $15 billion a month, which isn't close to the trillion. It can go into treasuries, it can go into corporate debt, it can go into equities. I think a lot of the private sector money has gone into equities. I think it's gone into tech. And so what you've created, Trevor, is this virtuous, truly reflexive cycle in the US. And the last time that we saw something akin to this was March of 2000. Okay? And when I look at Nvidia the poster child of this. This is a classic bubble. We've talked about, and I've been on your show before, the chart pattern that is a classic bubble that is driven by greed and then in the bust period when it peaks and drops by fear. I think this is the beginning, we're in the down leg of from the peak. This thing typically drops from the highs 30 to 40%, right? Maybe 20, but at least I would say 30 on average. That would probably get you to just under $100, right? At that point, everyone will go, it's a bargain. It'll probably happen going into earnings. If this is a bubble, what'll happen is it'll snap back hard at that point, but it'll never make a new high. Mm-hmm. And then that's when you sell it. And I think what people are seeing in price action at the moment is actually is wrong, because I think the price action is right, but the inferences that they're making is wrong. I think the reason why we're seeing growth, the SPW trade up, is because people will short it. Trevor, I really think the odds of this being sustainable, positive, as I said, reflationary rotation, I think are extraordinarily low. And the thing that I'm watching for signs is how far this dollar weakness starts to build, because if that builds, then a lot of that foreign money that's been in the US funding those deficits in US assets starts to go home. Because they'll suddenly, if you're a Japanese investor and you bought the Nasdaq in yen because you had to lend us the yen so we can go buy Lexuses, right? And run that big trade deficit. If the yen starts to strengthen, the dollar starts to weaken, and you own Nvidia, in yen terms, it's going to get worse and worse and worse and worse, that holding. And at some point, you'll cut that position and bring the money home. And that's what I think. And I think actually we're potentially on the cusp of a weak dollar move. Now, adding to this is talk of what Trump wants, who's clearly the obvious candidate. Yeah. But I think this sets us up for a really very, very interesting dynamic when it comes to, at least initially, precious metals. We talked about this, and you and I have met, on this podcast and talked offline and stuff, that, we've been very long gold for a while. We played around with silver. We just bought gold miners last week, GDX. I think this space looks great. We just have to be careful at some point, because you will get if you get enough of a dislocation in the equity market, you'll get what's referred to in the pro space as a VAR shock, a value at risk shock, where the stress in the portfolios of professional managers becomes so great that they even have to sell some of their winning trades. So in this case, that would be gold or silver or, whatever. Yeah.
So it's a move that would pull everything down.
Now, gold less than the Nasdaq.
Right, but I mean the risky equities.
Yes.
Right, okay.
Yes.
All right. Well, let's take a breath.
Lot to unpack there, mate. Sorry, there's just a lot going on.
Yeah, no, I hear you. Take a breath. Listen, there's definitely a sense of urgency behind your tone right now. And so it makes me ask about timing. Listen, it's been a volatile week.
Yep.
Lots of things have changed politically in the U.S., and because of the political changes and the election cycle and where we stand today, it seems like the market for the last couple days have really been pushing towards a Trump presidency.
Yep.
Trump 2.0. We saw kind of they think there's a replication. A lot of Wall Street investors think there's going to be a replication of what we saw during the first
1.0,
term. During 1.0. But we also know that, listen, things start getting very volatile when everybody's long.
Yes.
Are we to that point now that we've got that Trump on the horizon? We've seen what he's done in his first term. They think there's a replication in a second term. That's where nobody's short, everybody's long.
Yep.
Here comes a rug pull.
Yeah, I think every player category, domestic leverage players, so hedge funds, prop traders, long, individuals, long, index, via indexes and 401k. So long, 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 long. Foreigners, balls to the wall long. Right? Everyone is in the US markets. The whole world is in the US markets. The US market is now basically 50% of the total capitalization of the rest of the world. I think in the dot-com bubble we got to just over 50%, and we're now like 52, and I think we're now like 49 and a half, right? So the whole world has their money here, and it is driving this narrative of US exceptionalism, which I think is absolute bullshit. I live here, I love it, but I do not see anything exceptional of running a massive current account deficit, excessively easy financial conditions, and still having, core service inflation of above 5% and calling that exceptional, right? It's like if you ran up your bloody credit cards to the max, got drunk as a skunk, and you were saying, I'm just I am the best person in the world, look how clever I am. Yeah. There is nothing clever about that, okay? And so I have a feeling that we're coming to at least the initial stage. So it shouldn't be straight down, Trevor. It shouldn't be an 87, 2020 type, straight down move. But I do worry about the structure of the market. I do worry about the zero date to expiry, options, 0 days to expiry options, these zero DTE options, what that means for the setup of the volatility structure. And it's a really important, it's a complicated subject, but it's a really important part of the market. So I'm not saying it's impossible, but my gut is what we're going to get now is this. We're going to get a volatility shock. We're going to drop Nvidia down to 100 or something like that. It'll bounce, but we've possibly seen the highs already.
How much is Nvidia carrying this?
A lot.
Index
a
now?
lot. Like, I think it's 30% of gains year to date or something stupid.
Amazing.
And the problem that it creates is, if you think of a sort of finite pool, or you think of a balance between two kind of measures, right, in a closed system. So if one goes up, the other one has to go down. So if you've got Nvidia on one side and the rest of the S&P on the other, with a finite amount of cash in the system, as Nvidia's going up, everything else has been going down because Nvidia's basically been siphoning off cash. And what particularly locks that system as a closed system is that we've been selling a lot of volatility at an index level. So in other words, linked to the S&P. So the S&P is, I'm just going to say, the S&P is essentially, may change on Friday when we get the big expiry, been locked in a range, right? Been locked in a range where there's too many buyers. If it goes up, there's too many sellers. If it goes down, there's too many buyers. So it just sits, right? Now, what that means is if Nvidia moves up, as I said, everything else has to move down. So you're creating a lot of stress under the surface.
Right.
But at an index level, doesn't look like it's moving at all. And this to me is creating kinetic energy and stress that if those dynamics around the index start to change, and as I said, we're going into a seasonally more volatile time of the period of the year. If you look at a 30-year chart of the VIX, seasonality, the low is the 19th of July. So 2 days from today. I suspect this year it's a couple of days late. Okay, so we've already seen the low. But the general trend from here on up, Trevor, is up and to the right. And that movement in volatility up and to the right, particularly in election year, is going to cause stress.
Yeah. Isn't August usually one of the toughest months for the market?
Yeah, August, September, and October. They're just not, stress usually runs into mid to end of week 3, October.
And how much is the political cycle right now going to be a diversion from what's happening in markets?
I think people are trying to ascribe some of this to. Ascribe some of this to politics, and I think it creates a handy narrative, like, you know, the weak dollar that Trump wants. I don't know whether it's a factor just right here, right now. I mean, there's a lot of inconsistencies in some of the things that Trump conceptually aspires to. You know, we're told he wants a weak dollar, right. But he wants a weak dollar, but he's going to shrink the current account deficit. So he's going to impose tariffs. He's going to, you know, and that theoretically brings business back to the US, shrinks the, you know, how much we're spending on imported goods. The problem, the inconsistency there is the way that we as a reserve currency get dollars into the rest of the world is by running that current account deficit. So if you shrink it, you starve the rest of the world of dollars, and far from going down, the dollar would go up, right? So I think there's lots of inconsistencies there. You know, he talks about not wanting to see inflation. Well, if you impose tariffs, that's inflationary. If you shut down immigration, that's inflationary, because you try and grow and there's no workers, you can just push wages up, and that drives up core inflation. But so I think the narrative is coming into the market. People are using the narrative of Trump to explain some of the movements. I don't actually think right here, right now, that is what is going on, Trevor. And I think there's a ton of uncertainty what happens post-election. Hopefully we'll get a little bit more clarity when we see who Trump picks as his Treasury Secretary. If he picks a sycophant who's just going to follow along with everything that he does, then boy, oh boy, I think we're going to have a heck of a lot of volatility. If he ends up with a sensible voice, then I'm hoping that he can guide what is fundamentally, I think, quite a positive strategy, and remove some of the risks associated with the implementation of some of these things.
Jamie Dimon's name's been floating around for Treasury.
Yeah, I mean, I don't know whether Jamie would take it, but, you know, there are other people. I mean, Paulson's name's been out there, the old Treasury Secretary, the Goldman Sachs guy. Scott Bessent, the hedge fund guy, very smart guy, who's been floated. We don't know. We want an adult.
Right. Please, yeah. We would love an adult. And what's interesting is like this whole narrative around within markets on the back of this election it's just changed so quickly in 5 days, right? 5 days. And who's to say we could have this conversation now and tomorrow we would have a different conversation? That's
maybe. I mean, look, I think it's. You know, I've got lots of policy friends in DC who, you know, do this for a living, you know, from my old days when I worked at Medley Global Advisors, which was kind of a premier policy think tank. And they've been saying for a few months now that, you know, Trump was the odds-on favourite. I mean, he was just ahead in all the key states. And, you know, recent events, I think, have just cemented that. I think the only chance that the Dems have is that they kick Biden out and they replace him with potentially someone younger, female, minority, who could galvanize that vote, you know, and get Dems out. But I still think it's a long shot. I think against Biden's, you know, Trump wins.
Well, listen, we're a little under 4 months away from the election. And as we speak, it's like you can't turn on the news media anywhere where it sounds like they're ready for his inauguration.
Right,
it's going to happen. Like that's kind of the energy behind all this. I mean, and the polls and the numbers don't lie. But again, 4 months, things could change. Who knows? I mean, I don't think we're done with big jaw-dropping news on a Saturday or Sunday.
As I said, and then, you know, people are making all these. Like I'm trying to kind of avoid them because I'm hearing things like he wants the weak dollar. We just talked about that. There's lots of conflicts there. He wants to pressurize the Fed. Well, in the reality of the situation, he really can't. It's extraordinarily hard. Yeah. Powell can sit there and just go, all right? Yeah. And you could have a fight. In fact, I think my sense is, talking to policy contacts, as I said, is the Fed was already girding their loins ready for a fight with whoever got into office around the size of the fiscal deficit. and to make it clear that the Fed is not going to accommodate that. Okay?
Mm-hmm.
So, that's a source of tension. China is a source of tension. There's a source of tension around chip exports. Right?
That's recent news this morning.
Just this morning, right?
Yeah.
Admittedly, this is coming from the Biden camp, but I heard a tale from friends who were as close to the Trump 1.0 administration as you could get, that they were actually, there was a discussion had internally within the White House that they were going to arrest one of the tech executives for treason in front of all the other tech executives for exporting products that they didn't want to be exported to China, to just illustrate how serious they were about this whole thing. So this is going to be an incredibly hardline administration. And how does China respond? Do they weaken the renminbi? That seems they don't want to weaken the renminbi, but if you impose 60% tariffs on them, guess what, right? So next year could be volatility the like of which we haven't seen in an incredibly long time. So for the moment, with 6 months to run, I'm trying to keep my eye on the ball right here, right now. Mm-hmm. And right here, right now, it feels to me that the equity market is in the process of putting the top in place, that you're going to see more strains in the market. I'm watching this dollar extraordinarily carefully. I think it could counterintuitively weaken, not strengthen, in a risk-off move, particularly against the euro and the yen. That makes me inclined to precious metals. Silver's a bit of a bummer, but we've got gold on. And that's what I'm... And then I'd rotate into other metals as and when rate cuts start to come through and you start to see those reflationary kind of moves.
Sure. Okay, that's the big rotation question we're going to have. But I do want to come back to some of these policies on the back of if there is to be this move lower in the equity markets, what that means for the tools the Fed has at hand. Right. We're sitting at little north of 4% unemployment, interest rate at 5.25%, give or take. Feels like next month we're going to get our rate cut because they've been forced into that corner, and so there's a little bit of wiggle room for the Fed to move in here, but that unemployment rate is going to be really tough as one of their mandates. So.
Yeah, look, I've said from the get-go that if you look back at history, this sort of, and I think the market certainly up until a week or so ago was all in on the soft landing, Trevor. Mm-hmm. Right? The equity market was 100% committed to a soft landing, because if it was pricing a recession, it would be down. There's not a recession since 1930 where the equity market has been up, and the average decline is 30%, right? And we're certainly not pricing that. You have a bond market where you could argue, they're pricing in a lot of rate cuts, they're looking for the recession, but in actual fact, if you look at the shape of the curve, and I'm not going to get into it on this conversation, but if you look at the shape of the curve, you look at the shape of the inflation-related bond metrics, what they were really pricing was a rapid fall in inflation, and then the Fed could cut, and we could get back to that reflationary nice kind of rotation idea. I've been very clear that that's a very unlikely scenario, right? If you go back and you look at all the tightening cycles since 1960, you've had 12 Fed tightening cycles. Now, with the exception of Volcker, who was really intending to take your front teeth out, right? Most of them, I think, have approached this thing hoping to achieve a soft landing, okay? Mm-hmm. The problem that they have is they either step off the gas too early and inflation comes back, which happened in the late 1960s, or they hold rates too tight for too long and they lose control of the labour market. And once you lose control of the labour market, Trevor, it doesn't go sideways. This is really a strange economic metric, and your listeners or viewers can play with this. If you can run a moving average over unemployment, and you can pick a moving average where if it crosses, you actually historically get a recession. Now, we crossed that in February, and you could say, okay, well, why have you not been kind of calling for the recession since then? And I think that the issue is we know that kind of immigration is messing with the unemployment rate itself. But nonetheless, that's the danger, that you hold rates for too tight for too long and you go into recession. And the statistical odds of you going into recession are very high, like 65% of the time in a tightening cycle, you've gone into recession. So between those two, either you step off the gas too early, inflation comes back, or you hold rates high for too long and you go into recession. That's basically 75% of the time, right? 75% of the time, which really means there's only been 3 soft landings out of 12 since 1960. And what I think makes this one even harder is every single one of those others has occurred with much higher unemployment. To go back to that point that we had, the 2000, those were obviously not soft landings, but the point is you have the slack in the labour market then to have that reflationary re-acceleration of growth. Now, I know that the equity bulls will say, yes, but AI, this is 1995, this is the beginning of the bull market that was driven at the beginning of the dot-com as productivity explodes. Perhaps, and I'm certainly eventually, yes, but right here, right now, US productivity has been trending down for 3 years, and there is literally not a single sign of a pickup in productivity in the US. So this is hopium driven by the equity bulls, not reality.
Well, and also political hopium, because one of Trump's stances is he wants to reindustrialize the U.S. and forget all the globalization that's been going, right? So, I mean, that is
good luck in that and having the reserve currency, but that's another story.
Yeah, so, but that is, that is the main topic. We saw just yesterday on Tuesday there was huge moves in kind of U.S. traded, U.S. based companies, at least on the mining side. I mean, a lot of buying was going into some of these projects and these companies. And, we were kind of having this conversation back and forth on Twitter about, if this was the Trump trade, people getting positioned, ready for that, or if it was something greater than that. I mean, if that's what he was, isn't that the obvious trade here, going into an election, and then maybe it's a sell the news if he wins?
Look, yes, that's a good trade. I think one's got to be careful. I think... you know this better than everyone. It's quite hard for the US in a timely fashion to be the provider of all its minerals, right?
Sure.
Right? You have to include Canada. You have to include Australia. You have to include other friendly Northern European nations who've got access to some of these minerals, right? So I think it has to be a them and us, right?
Right.
So don't get me wrong, great trade, fine. But as with all trades, the thing that is worrying me right here, right now, is right here today on, what are we, Tuesday? Wednesday? I can't remember.
17th.
Yeah, the 17th, right? It's a blur. I've just been working all week. Right here, right now, that looks like it's working, Trevor. But if your broad market volatility starts to pick up, even your winning trades are going to be down, because everything is going to get degrossed, right? So if the equity market drops 20%, I would be surprised if gold were up. It won't be down 20%, but it might be down 10 or 5, right?
Right.
And even then your mining stocks will probably be down more than that, because they're very volatile trades. So
are you watching, you talk about kind of watching a tick up in volatility. Just keep that chart of the VIX open if you see
I think so.
Higher highs, higher lows.
If you have access to Bloomberg, there's another metric you can watch, which is the cross correlation between stocks within the S&P, and that's kind of a metric of stress for long short equity hedge funds. As it rises and correlations mount, then all their stocks increasingly start to move their shorts and their longs move in the same direction, which is obviously not what's supposed to happen, right? Your short's supposed to go down, your longs are supposed to go up. That's supposed to keep your volatility pretty low, right? But if they all start trending in the same direction, then you have to degross your book. You have to reduce the size of your book.
Yeah.
And that leads to a broad market sell-off.
Okay. I want to ask you about this move in the Dow last couple days because it's completely outpaced the S&P and the NASDAQ. Wondering what you're hearing from your contacts. It doesn't happen very often.
No, but it goes back to this, what we started talking about, right? If you go back and you look at the spread between the S&P, basically the NASDAQ, 30% tech, right, versus 50% tech in the NASDAQ itself. And the Dow, very low amount of tech, a broader market metric, the SPW, that's what it is, Trevor. It's that manifestation of, growth, names selling off, tech, growth, and value, Dow, rallying.
Mm-hmm.
I don't see that as a sustainable, ongoing metric. I think at some point, the weakness in the NASDAQ, given the concentration of money in that market, will short circuit that positive rotation. Yeah, sure, the Dow will outperform, right?
It's not,
but that rotation goes from being nice, Dow up, NASDAQ down a little bit, right, to nasty, everything down, Dow down less, NASDAQ down a lot, right?
So you mentioned kind of the positions you're in on the precious metals. You mentioned silver. You and I have been going back and forth with silver for about 3 years, I think.
It's gone up.
It has gone up, but you look at the gold price. Just Tuesday, gold makes a new all-time high, and silver is there. Silver's there.
Yeah.
So he could play some catch-up, but at the same time, on the equity position, you mentioned you're long the gold miners, I assume, like the GDX.
Yep.
When is that trigger? What are you looking for that trigger to say, okay, the time's up, take my profit, leave, revisit it if there is another pull down?
I think stress in the broad equity market at some point. If I see a day when equities are down and the GDX is down kind of in line, then I'd be like, this is... And as I said, I'd be looking at the correlation moves, the volatility of the overall market, because the thing that's going to force me to sell that position is when I think the market is going to have to start to cut its broad risk, winners and losers.
Yeah, okay. Speaking of gold miners, next week's a big week. We start getting financials coming in from the producers.
You and I talked about that. You think these are going to be
I think
blowout numbers, right?
I think there's potential for blowout numbers.
Right.
I think it's going to be... It could be potential
for
most of Wall Street.
Yeah.
People you talk to be like, well, why the hell do we miss this?
Yeah, exactly.
Yeah.
So I've been looking at a chart of GDX, right? And if you look at it, it's a very clear downtrend. I think it was in 2012.
Yeah.
And we broke it 3 days ago. Like, just blew out through the top. Or 3 weeks ago. I can't remember. I think it's a weekly chart. It was a daily chart. I'm sorry, I can't remember. But SIL is right on the same trend line, but it just can't do it yet. So come on.
Fingers crossed. Well, this could be very interesting because if you get some actual value out of the gold miner, something we have not seen in a very, very, very long time. Conversations you're having with your sources, are people starting to pay attention to the gold miners right now waiting for this? Nobody cares.
It's such a minority sport, right?
Yeah,
you can't take 10% out of Nvidia and stick it into the gold miners. You just can't.
You lose your job.
Well, there's no liquidity there. How much would the gold miners go up on 10% out of $300 billion?
Oh, quite a bit.
Yeah, quite a bit.
Quite a bit.
And that's just out of Nvidia.
Right. Oh, because I think Newmont's the only gold miner on the S&P, and it makes up like 0.022% or something. So if you double that, obviously that'd be pretty incredible.
Yeah.
And it wouldn't take a lot of money to do it.
I think this is where we're going, Trev. Right? I'm just, I like, and I think, we've talked about them before. I love the guys from Northside Bad Chart. And I've had them. I've sent some of their stuff around to people. I've been on their show a couple of times, and I think they do really very objective charting. And they have this one chart, and shoot me if I'm wrong, but I think the long-term objective for silver is like $150, right? Now they're talking many years, and I on the shows I got this call, and the guy was like, "Yeah, that would be great," I'm like, "No, mate, it won't be great." Because the conditions that get silver to $150 I don't know whether you want to be living you've got to be very careful where you're living at that point societally. But I do see that sort of potential, I think. But what they talk about is a run up in silver to sort of high 30s, very low 40s. Then they see a big sell-off back to kind of the breakout level, so kind of $28, and then from there, up she goes, and then it's inexorable sort of to infinity and beyond kind of level. And I think what you're looking at in that sort of situation is a sort of positive rotation, kind of weak dollar gets you up to upper 30s, low 40s in the next few months. Then a big sell-off in equities, right? A big sell-off in equities that just hits everything. And then a Fed that eventually has to come in and print like Billy-O, cut rates, a weak dollar, and that's when up she goes.
Okay. So what is, you've probably given a lot of thought about portfolio allocation here. You talk equities, bonds, gold, cash. I mean, what do you think?
So, no bonds. Tactically, sure, you can have them, but from an asset allocation perspective, I think, they're an instrument of confiscation. They actually just blew through, at the beginning of this year, a 35-year trend support against total returns in treasuries. So including your coupon, right? Treasuries have underperformed against gold massively, and now they've just broken 35-year support. There is a lot of downside on that relationship now. So I think precious metals are your hedge. So no bonds, except from tax. Look, you go into a recession, 10-year treasury yields can fall to 3%, right? Fine. Right here, right now, I've still got some equities, but not many, and I'm trying to look to rotate into what I think are cheap value equities, but even then I'm worried. I've got quite a lot of commodities, but even though some of those I'm worried because they're growth related, some of them. So, copper, those sorts of things, platinum. I've got European exposure, I've got Japanese exposure, so non-dollar exposure. So I'm kind of playing even if the equities go down, hopefully the currency will go up as the dollar goes down, so that will kind of cushion me there. And I'm actually running quite a lot of cash.
The gold position, the allocation for gold, you mentioned it, having it as your hedge. We've always talked about that, 5% gold allocation, 10% gold allocation. Higher now?
25.
And that's a specific number because I just had dinner last week for a good fan, Adam Thurgood. And one of his products is 25% gold allocation.
Yeah, Adam manages some of my money. And I think he's right.
But we're not seeing that active Western buying coming into gold yet. Not like China did this year.
No, we're not. We've actually seen in the last few weeks, we've seen quite aggressive ETF buying. Not sure where it's coming from, but they're US-based ETFs, so you would hope some retail investing coming into that. But I think it has to be high.
I remember a year ago we sat on this very patio and did a very similar conversation, kind of seeing where your thoughts were last year in 2023. And I remember you saying, precious metals, gold looks good, but I kind of wonder if this is one of those markets where the metal moves higher, but the equities lag. And nail on the head.
The nail on the head. Much to everyone's frustration, I think, right? Because we all want the high beta one.
Yes.
Come on.
I'm going to retire, be a billionaire, get my Lambo. I'm going to get a Lambo off my junior mining stocks.
Exactly. So I think that's as I said, I think GDX looks kind of interesting. I mean, you just said you think the numbers are going to be good.
Mm-hmm.
So, let's see. SIL looks very, very similar to GDX. GDX has broken its downtrend. SIL is right on it. So, fingers crossed.
Yeah. Okay. Julian, I know you're busy, so let's leave it at that.
Thank you, Trevor.
Thank you. Appreciate your time, and let's touch base later this year.
Cheers, mate.
All right. Julian Brigden, MI2 Research, everybody. And that's a wrap here from Mining Stock Daily. We'll be back Monday morning with the morning briefing. Have a great weekend. Be well.